Okay, some big tips with realtors here. When you have a pre-approval, a client comes to your office, says, I've been pre-approved for X, Y, and Z amount, and you know that's not going to be a sufficient amount for you to get them into the house that they're going to need or whatever the situation might be. How do you fix that? And how do you make it so that they're able to qualify for more if you refer them to someone like me? Number one, most pre-approvals are based on the fixed rate that is the 120-day rate hold. So this means with the qualifying rate, which means you take the contract rate or not less than 5.25, which as of this video, we're in a situation where we have to take the contract rate. So if you're getting a rate of 4%, you have to qualify at 6%. If your clients qualify based on the rate they're being held, that's always going to be higher. So you want them to qualify based on what the 30-day rate for a fixed rate is or the variable rate. The variable rate at this time is much lower. That's going to make a difference of $50,000 to $70,000 on their pre-approval. Is most times when people come from a bank, they're qualifying based on a higher rate, which erodes their purchasing power. That's number one. Number two, are they considering the idea of a house that is suite or that has a suite or is suitable? So if a client buys a rental property that has a suite inside of it, that's going to skyrocket the amount for their pre-approval. But little known fact, you can buy a home and you can have the cost of suiting the home put inside. That's going to go up. Those numbers look like about $150,000 difference. The third thing is a question you want to ask your client. When you went to get pre-approved, was there any income that your lender or your broker said they couldn't use? And you'll be surprised to find that a lot of those incomes that maybe one lender, one bank, or one credit union say no to are definitely sources of income that other lenders will consider. So if they tell you that, that's really important because we can go to a different lender that allows all that things. The fourth thing to look at is, does your client have significant net worth? So maybe they have $300,000 in TFAs or investments. This is going to make a pretty meaningful difference because what happens is that if someone's putting 20% down, we can add the net worth to their qualification. If they qualify for 300 grand and they have 300 grand in the bank, we can now call it 600. That's the other tip to look for. The last tip to look for is if a client has debt, any type of debt really, there's a few ways we would play around with the debt to increase their qualifying capacity. So there's kind of like some subtext here. Number one, if they have a car loan, we can redo their car loan into a lower payment, re-stretch it out. Number two, if they have a student loan, the student loan, oftentimes people have student loans that don't, that are not being paid yet. They're not in repayment, or they have a higher payment. They're paying off faster. We can re-amortize that and put that as the minimum payment. Those two solutions themselves, the average client gets 75 to 100 grand more for qualifying capacity. So lots of options on that from that perspective. So if those sound like things that you're like, oh, my client mentioned all those things, have them reach out to us. We definitely can get them to a better pre-approval number.